You finally sell your business. You hand over the keys, take the deep breath, and think, I did it. I'm done. I'm free. Then a few weeks later, you get a letter from the IRS. Not a congratulations card, but a bill for 30% of your life's work. You built this dream from nothing. Late nights, duct tape budgets, payroll roulette, caffeine, and grit. And now the IRS wants to ride shotgun on your retirement? Here's the contrarian truth the wealthy already know. You don't have a tax problem. You have a structure problem. And I'm about to show you how one plumber legally turned a potential $900,000 tax bill into a lifetime stream of tax-advantaged income. No loopholes, no magic, just IRS-approved strategy. And before we dive into the strategy, you need to understand why most CPAs never warn you about this. That's coming up next. Hello, my name is Robert Balgac. I'm the founder and CEO of Black Swan Insurance Group. My team has helped protect over 20,000 families and earn more than 800 five-star reviews by helping entrepreneurs turn income into independence without Wall Street chaos or IRS ambushes. And here's the key. Most CPAs are trained to report the past. Our job is to design the future. So if you're planning to sell your business in the next 5 years, your job is not finished. Entering the most important stage. You can click on the link below to book your free tax-free exit plan call with us, and we'll do our best to help you minimize that check to the IRS. But to understand why this matters, you need to meet Paul, the plumber who discovered the hard truth every business owner eventually faces. And his story sets up the entire strategy. Paul is the original Main Street millionaire. He started plumbing services business in 2005 with one van, one wrench, and the belief that no one outworks him. Fast forward 20 years. Now he has 7 trucks, 14 employees, and a sterling reputation. Then one day, the buyer slides a purchase contract across the table, $3 million. Paul's chest filled with pride. Until his CPA delivers the gut punch. Congrats, Paul. You now owe about $900,000 in taxes. The hardest part of building a business isn't starting it. It's selling it without losing half of it. And the emotional truth? Paul wasn't afraid of taxes. He was afraid of telling his wife their nest egg would shrink by about a third overnight. So Paul called us. We showed him what we call the tax-free exit plan, a legal path to turn his biggest tax bill into his own family bank. But before we get into the big move that saved Paul, you need to understand the trap nearly every business owner falls into when selling. It's called the liquidity gap, and it changes everything. When small business owners sell, they focus on a sticker price, but not driveway value, the amount they actually drive home with. Paul sells for $3 million. Federal and state taxes take roughly 30%, and that's $900,000 gone before retirement even begins. This isn't a tax bill. It's a wealth leak. Paul looked at the math and asked, is there a way to plug in this leak? Yes, with something you probably never heard from your CPA. A fully legal executive bonus plan under IRS code 162. And the moment you understand how Paul used his 162, you'll see why his CPA's jaw hit the desk. That move is next, and it's brilliant. So here's the move Paul made before the sale closed. His company pays him one final $500,000 executive bonus, fully deductible to the company under IRS code 162. Yes, Paul pays income tax on it now, but he funnels it into a tax-free exit plan we designed using an IUL policy structure under IRS 7702. This is where the nuance matters. To avoid violating IRS contribution limits and triggering MAC rules, you can't drop the entire $500,000 into the policy at once. So we structure it over 5 years, $100,000 per year for 5 years. This is like filling a vault one brick at a time. Each deposit grows quietly, protected from taxes, and insulated from market crash. With this setup, Paul's policy cash value is projected to be around $750,000 to $800,000 after 10 years. From there, he can take policy loans that could give him around $50,000 per year of tax-free income for the rest of his life. And this is the part where Paul's CPA squinted at us like we just unplugged his calculator. But the part that entrepreneurs love most isn't the bonus. It's what happens inside the structure once the money lands. The 7702 engine is next, and that's where the magic happens. So here's what happens under the hood. Your money isn't thrown into Wall Street's blender. It's linked to an index, often the S&P 500, with a 0% floor and a cap that's typically around 10%, depending on carrier and structure. And when the market crashes, Paul earns zero, not negative. And when it rises, he participates up to that cap. Then his cash value grows tax deferred, and when he needs income, he takes policy loans, borrowing against his cash value without triggering taxable events. It's like having your own family bank. You can access the money, but the bank keeps compounding. And when Paul eventually passes away, his remaining death benefit goes to his family tax-free under IRS Code 101. Now that you're seeing how the engine works, the only question is whether you'll keep more of your exit or hand it to the IRS. So let's talk about your. Most entrepreneurs sell and pray. Paul sold and planned. He turned a final bonus into his financial fountain, income for life, legacy for his family, and a peace of mind that outlived the business itself. And this isn't about outsmarting the IRS. It's about using the IRS rulebook better than they expected. So if you're even thinking about selling your business soon, this is your window. Once the sale closes, the opportunity typically disappears with it. And yes, bring your CPA. The best CPAs love this setup once they see the math. So you can click on the link below and you can book your free strategy session with our team. Because the decision you make next will determine what you enjoy for the next 20 years. Two entrepreneurs, one sells and pays, the other one sells and plans. One writes the check to the IRS, the other one writes his own future. The IRS measures success by income. Entrepreneurs measure success by independence. Choose the exit that respects the decades you spend building your dream. And remember, not what you earn, it's what you keep. Enjoy the ride.